Hello, everybody, and welcome. Thank you so much for joining us today. My name's Emily McFarlane, can't even pronounce my own name, and I'm the marketing and partnerships lead here at VentureCrowd. I'm really excited to be hosting this session today, all about the Sydney Angels Sidecar Fund 3 in collaboration with VentureCrowd. And we have already reached over $3.7 million raised, which shows a huge interest from investors who are wanting to access high growth early stage startups with the backing of one of Australia's most respected angel networks, which is Sydney Angels. So joining me today, I've got Adrian Bunter from Sydney Angels. He's been the driving force behind a lot of early stage investing in Australia for more than 3 decades at this point. He brings an expertise in startup funding, angel syndicates, and fund structuring. So he'll be walking us through today how Sidecar Fund 3 works, what makes it unique, and what investors can expect to see in terms of strategy and pipeline development. So we'll aim to keep today's session relatively interactive. So if you've got any questions while Adrian is talking, please feel free to pop them in the Q&A box at the bottom of your screen as we chat. We've got a few already that have come to us before we've even opened this webinar, which is great. I will just let you know that today's session will be recorded. So if you do miss anything, a recording will be sent around, and you are welcome to send that recording on to anybody that you think might be interested. I will stop yapping now and I'll hand it over to Adrian.
Thanks, Emily. See a group of people sort of still popping into the webinar. Look, as like you said, this is supposed to be a relatively informal chat and presentation. So it'd be great to sort of get questions. We find it's just easier sort of to talk in a lot of cases through the specific questions that people have. But what I might do is sort of just give a high-level overview of Sydney Angels and the Sidecar Fund for those people who may not have had a chance to go through the information memorandum, or maybe bring some of, if they have had a chance to sort of bring some of that more to life, so they actually understand how it works in practice. So as you outlined, Sydney Angels is one of Australia's leading angel investing groups. It's been going for about 15 years now, and it's been relatively consistent in how it's operated. So the original thesis and the reason why Sydney Angels started was to give angel investors an ability to work together and actually do a collaborative investment approach. So getting the applications coming in from startups, working on those together, screening those together, and then doing due diligence together, and then supporting those companies once they've been funded. It's really beneficial from an angel's perspective because it consolidates and actually gives a central place, and actually you get to leverage other people's expertise. And it's also great for the entrepreneurs because they get to do one application and one process and go through a fairly methodical process with the angels, so they can hit lots of angels in one go rather than have to go and do 50 or 100 coffee meetings and all those kind of follow-ups. So one of the things, and if you talk to people about Sydney Angels, especially the entrepreneur level, some will say positive things and some will say negative things. The negative things will be, it takes a while. There's a process. They put you through the ringer on the due diligence, which some people see as negative. That's normally said by people who don't get through the process. But a lot of people actually see it as a really strong positive, and they get really good feedback on their business going through that. But what it does from an angel investment perspective is it probably helps to weed out companies and filter out companies. So I have an expertise in a sort of broad, so I'm not a tech person per se. I'm not the entrepreneur. My background is finance and accounting. So I come at it from a financial perspective, M&A perspective, corporate advisory. So I will never claim to be an expert on technology, but I've got other members of Sydney Angels who are entrepreneurs, who are coders, who have done the technology side of things. So I can lean on them and get their guidance, because something can sound fantastic to me, but it's actually, it's pie in the sky, and very, very difficult to do. So I think that's sort of the core benefit. As this fund is creatively named the Sydney Angels Sidecar Fund 3, would imply that we have also done sidecar funds 1 and 2 previously, which we have. So this is the third iteration. It follows the exact same process of the first ones, and it's called a sidecar fund for a particular reason, in that it goes alongside the angels and co-invests alongside the angels. It's in effect what we call an automatic co-investment vehicle. And what that effectively means is, so long as an application comes through the Sydney Angels process, follows their process, goes through that due diligence and passes that due diligence, and then at least 3 Sydney Angels members invest in that company and do the transaction, the sidecar fund will co-invest alongside those members. It's got a validation check from the investment committee of the sidecar fund, which makes sure that the process has been followed, makes sure that due diligence has been done, makes sure that the terms and conditions of the investment are normal and reasonable around it. But what the sidecar fund investment committee is not trying to do is not trying to second guess the angels. It's not trying to then go and do a whole lot of other due diligence itself. It's relying on the work that's been done by those Sydney angels. So it gets the value of the expertise. So if you think about a traditional venture capital fund, it normally has a small number of principals and a couple of investment analysts. So you might have, in a small fund, 2, 3, maybe 4 people being involved in, sourcing, doing due diligence, managing, and doing all of that kind of stuff for the fund. With Sydney Angels, we've got we bounce between sort of 70 and 100 members. Most deals have got half a dozen to sort of up to 20 members investing in a particular deal. So the sidecar fund is effectively getting access to those 6 to 20 people who are all like investment managers, who are all heavily aligned with the sidecar fund, because every single one of those investors has put their money where their mouth is. And so they actually have a really strong vested interest in making sure it's a good investment, but also helping the company after it's done that initial stage. I might just pause there because I've been rambling and talking for a couple of minutes through that. Not sure if we've had any questions come through, but if we haven't, I can ask some of the ones that sort of answer. We can talk about a couple of ones that come through that have come through previously.
Yeah, absolutely. So at this point, do you have any visibility yet on the types of startups that Sidecar Fund 3 might be investing in? Are there preferred sectors or thematic areas you're targeting, such as AI, health tech, climate?
Yep, that's a really good question. Is one of the things about the sidecar fund, in particular Sydney Angels, is it's broadly sector agnostic. So it doesn't go out and say we are looking for this particular area or this particular type of company to invest in. There are some things that we generally don't invest in. So we won't invest in property related stuff. We won't invest in mining things. We won't invest in finance. However, we will invest in technology components that sit alongside those. So as long as it's got a technology component, it's you want something that's high growth, high scale, scalability, big market size, and big opportunity. That's where we'll be focusing. Now, companies come through in waves. There are themes that become popular. If you go back, and one of the sort of core underlying things that comes through from the startup, especially in Australia, is people like SaaS, software as a service, subscription as a service. People like B2B types of things. So you will see like a fairly decent proportion of companies that are B2B type businesses and have SaaS-like business models. But you'll then start getting flavors of things that come through. So it used to be, there used to be a whole lot of fintech ones. Then there used to be a whole lot of blockchain ones. Now we're seeing more and more AI related ones. So you do see these themes coming through. I think we're going to see a lot more companies that are leveraging the advantages of AI. We'll see some like pure AI first driven companies, and then we'll see some ones that are using AI to actually enhance it. In fact, I think there'll be a point in time that every single company will have components of AI in it if they're building it well. The same way that every single company is a tech company now, because they all leverage and use technology today compared to sort of 20, 30 years ago when they didn't do that. But yeah, there's some really So out of some of the stuff that's currently coming through, there's some really interesting ones. There's a couple of biotech ones, which Sydney Angels has had some really good success with in the past. Some one of the best return investments the group's ever made has been in a biotech business, a company called Clarity Pharmaceuticals. It was invested in quite early. Those first round investors from when it listed on the Australian Stock Exchange. So the increase from that first round investment to the IPO price was 50 times. I think it was 49.7 times markup from that. At its absolute peak, it actually reached 270 times the original investment entry price. So yeah, it's a pretty spectacular return, and there's a couple other good ones in the broad portfolio, and then a couple more coming through as well. So a medtech devices. There's a few interesting AI ones coming through the pipeline that have sort of passed through that initial screening and are actually in process at the moment. So I'd like to think we've got some of those. And then there's also some interesting follow-on opportunities. So one of the benefits of the third Sidecar fund is that it will do initial first investments in companies that first apply to Sydney Angels. So their first round of funding will be coming through Sydney Angels, but it also has the ability to co-invest or invest directly into follow-on opportunities that have been previously invested in by Sydney Angels. So you'll have companies that might have been invested in 1, 2, 3, 4 years ago that are still coming through doing the next round of capital, and we'll see those and get access to those as well. And those companies will be a little bit more advanced than those sort of earlier stages. We will have had the benefit of seeing them operate for a period of time. We'll have more data. They're likely to be slightly higher valuations, but we'll still have a look at those ones. Those deals are what we call discretionary deals, so they're not automatically investing, but we'll still take guidance from those earlier angels. Like if those earlier angels are co-investing and investing more money, that's a really good sign that they still believe in that. But we'll have to do more independent due diligence as the investment committee of the Sidecar Fund.
Good to know. So for investors who might already be active in startup investing, say through various digital platforms or direct deals, what would you say the real point of difference is when they're co-investing via the Sidecar fund?
Yeah, there's probably a couple of key points in that one. One is if you're an individual investor doing stuff like which I am, it actually takes a lot of time and effort to go through, do the due diligence, be very hands-on, and actually manage it. So, angel investing is a fantastic opportunity, whether you call it a hobby, a pastime, or a sport, or something like that. But it requires a lot of hands-on activity to do it. The Sidecar fund is passive. So what you do when you invest in the Sidecar fund, you're getting access to the entire portfolio that gets invested in that goes through that due diligence. So, you would need to have in a lot of cases quite a significant amount of capital available if you wanted to invest in 25 startups directly or 30 startups directly. Whereas investing in the Sidecar fund, you get that automatic exposure to that whole portfolio from just writing a single investment. So that's sort of one benefit. One of the other key benefits is actually the tax structure. So the Sidecar fund is structured as what's called an early stage venture capital limited partnership, ESVCLP. I think Steve Marbarney from VentureCrowd says it's probably one of the most terrible names, but probably one of the best things it is from an investment perspective. What that does for the investors is it generates two things. When it qualifies as that ESVCLP, it generates a 10% tax credit on the capital that gets invested in it. So you lodge your tax return, you effectively get 10% back. So if you've invested a total of $100,000, you'll get $10,000 back. The other part of it that's really good is all the returns that come out of that fund are tax-free. So when it makes that capital gain and makes that distribution, all of it's tax-free. So there's not a lot of other scenarios where you can make good gains on things and pay no tax on it. You do have the ESIC, which is the early stage investment company opportunity, but that is very, very narrow in terms of when it applies. So it applies only really as at that earliest and first stages of a company. So you can't then put more money into the successful company and still have that tax free, whereas the Sidecar fund can. Yeah, so it's really that two ones. It's the tax advantages and instant diversified portfolio.
Awesome. Thank you. So at this stage, are there any limits in terms of the amount that's being raised or valuations for the ventures that you'll be investing in?
When you say limits of amounts being raised, look, so Sydney Angels, what we're generally targeting is those relatively early stages of companies. They are generally companies looking to raise, in the range of, at the smaller sense, sort of $300,000 to $500,000. At the larger end, probably sort of 500 to a mil, maybe a little bit over that. They would normally have a range of investors in it. So it's Sydney Angels is not usually the sole investor or sole group investing in it. We would normally have external investors as well. On very small rounds, yes, we might be the sole investor, but for larger ones, there's generally others. So we work together with others. Sometimes there are other people who know and respect the Sydney Angels investment process. If they know it's going through there, they will actually sort of jump on after we've done due diligence and they know that we're comfortable with it. We also liaise with other angel groups around the country. So all of us sort of share deals once they've done a preliminary due diligence. So we will quite often share deals with those other angel groups, and we've co-invested with Melbourne Angels, with Southern Angels, with Brisbane Angels, with Perth Angels. So that's really good, and you get a lot of collaboration. And then in terms of valuation of the ventures, the valuations move around a little bit. Like we try to target things that I'll call them in that sort of $3 to $5 million round. So it's normally that very early first external round. We have had some investments at lower than that. We've had a handful where the first investment round has been slightly higher than that. So sort of you will see some in the sort of that $6 to $7 million round. And I think we've done one, the group has done one, which is more like a Series A type investment, but not quite a Series A. And it was sort of low double digits for that. But it was a lot more progressed in terms of its revenues around it. So, yeah, but we're not looking to target Series A companies. We're not looking to target companies that might have, 15, 20, $25 million valuations, because the entry price of a valuation is very strongly linked to the returns you make out of those companies. Because whilst everyone wants to chase and find a unicorn, the vast majority of companies will never get to those kind of levels, and they're more likely to be targeting trade exits, in that $50 to $100 million price bracket.
Absolutely makes sense. So, what might be the percentage split between new companies versus follow-ons in the portfolio?
Yeah, so the way, and I sort of didn't touch on this earlier, but the way Sydney Angels works from a cycle, so we have 6 application cycles a year. In each of those companies, you'll get sort of 30 to 50 companies apply to each one of those batches. And then they go through a filtering process. So they go through a deal screening process where that 30 to 50 will get screened down to what we think are sort of 6 best opportunities. Those 6 best opportunities will then pitch to what we call a deal screening meeting, which is about 15 to 20 angels who will sort of screen that investment. And we rank those companies from 1 through to 6 to think what we think are the best ones. And then we aggregate their scoring together to come up with what we think are the 3 best opportunities. We then provide feedback and some coaching to those, and 2 weeks later they do an investment pitch to the full members meeting, which is a similar format. They do a 10-minute presentation, 10-minute Q&A, and then members have a little bit of a conversation and express interest to see who's interested in learning more, and that's the starting of that syndication process. So if you think about that over a year, there are 18 companies that effectively go through a full members meeting process. And out of those, you'll get sort of 6 to 8 that would get invested in generally across the year. So we've got a 4-year initial investment period. So I think where you'll end up getting is somewhere around that, call it 2025 companies will get invested in that are new companies, whereas they're very, very first round investment. And look, I think there'll probably be 8 to 10 other ones where there's sort of follow-ons from more recent companies that have come through. So that's where you sort of get 25 to 35. Part of it depends on just the total amount of capital being raised, how big the fund is. There's been really strong interest in the fund at the moment. We're going to get to we want to get to a $10 million minimum once we go through sort of the final close. But there's all the potential that it might go above that. So if it goes a little bit above that, there might be some opportunity to sort of have a little bit more follow-on in there as part of that as well.
Awesome.
I hope that answered that question.
I think so.
Yeah, yeah.
Um, I mean, this might be a difficult one to answer because I suspect it'd be quite broad and quite in depth, but what is the general scope of your due diligence, in particular, about software and technology?
Yeah. Um, so the benefit of the process of due diligence with the syndicate is you got a group of people doing it. So the I suppose the easiest way to see that technology actually works is to have paying customers who are actually continuing to pay and renew. So that's sort of the first guidance. What we will often do though is someone who's the tech expert in the team on the DD committee will sit down with whoever the appropriate tech person is on the company and sort of understand what's the status of the code, how does it actually work, what's their development methodologies, what are their plans for development over the future. It also depends on how advanced that team is. Like if they're really early, quite often you might only have a single tech founder, and part of their use of capital will be to raise more capital, to raise that capital to actually hire more people. Some of those people would generally be tech and investment in product, and then sort of sales and marketing. Um, so really, it's about that's probably the easiest way to describe it. Again, this is me being a non-tech person answering that question. But the if it's got we've invested in a company, for example, that didn't have its tech finished and didn't have any revenue. So you couldn't test it to see that it actually worked. So we spent a lot of time understanding what had been built so far, what the roadmap plan was, actually doing, we had one of the members do a code review of components of it. And that company was also working with a number of customers to sort of plan out the tech to make sure it was actually fit for market, because there are too many companies that build tech on the basis of, hey, I'm going to build this and they will come. And they're building something that's not actually right for the market. So we spent quite a bit of time just understanding that. And the other thing with that one is, we had some industry participants actually co-invest as part of the transaction as well. So that gave us a lot of comfort that there was demand in the market.
Awesome. So got a lot of questions that's come through, which is great. So when is it expected the unconditional ESVCLP status would be obtained? Is that FY26?
Yeah, so we need to get to $10 million to get the unconditional status. So we have a conditional registration at the moment. And really the only condition to satisfy is to get to that $10 million status. Based on the progress we're making at the moment, I think, yes, it will, I'd be extremely surprised if it's not FY26, and I'd like to hope it's, this side of Christmas that we actually get that unconditional registration. I think you said earlier we're sort of sitting at 3.7 million worth of applications. We sort of had an initial estimation of 1 million for the first sort of the minimum stop on the first cutoff. We'll sort of go for a little bit longer on that so we can sort of start doing some investing. We had 6 million come through in the expression of interest, with a lot of people sort of having no amounts there. So given we've only been open for day and a half or 2 days, I think it is. I think I think we've got a really strong ability to get there sort of relatively quickly.
Yeah, absolutely. So, noting that Sidecar 1 must be nearing the end of its life, is the intent to in species transfer remaining holdings to investors, i.e., those who have not exited nor been written down?
Look, the Sidecar Fund 1 is managed by a different investment manager. So it's the same structure, but so we can't sort of opine on exactly what will happen there. But as a Sidecar Fund 1 investor, I can say that what I understand and what I've seen is the vast majority of the portfolio has been exited, which has generated almost 2 times return net of fees, tax free so far back out to investors. There's still a handful of companies left in there, and the fund manager and the portfolio companies are working together at the moment just to work out how to do that. So there's a couple of different options. Either sell those companies and liquidate them into cash, or you could do it in species distribution, or they could be rolled into a separate trust around that. So I think a couple of the companies that are there are still really good companies, and therefore I think they're probably not the ideal time to exit them. They've still got some significant upside. They're probably worth more than what they're being carried at in the books of the company, because quite often the investment only gets carried at the last round valuation. It's one of the companies in there. The company hasn't had to raise any capital for a significant period of time because they're profitable and they've got far more cash in the bank than what they've ever raised. And that's still being carried at that last round valuation. So that is worth a lot more than what it's in the books at. So I suspect that will either have an in-species distribution or sort of a rollover into a continuation vehicle.
Awesome. So when is it expected that the first 1 to 2 investments will be made post tranche one closure?
Yeah, so if we think tranche one closure is probably going to we've got to collect the cash, but it's probably going to be sometime in the next few weeks. Like I said, there's a couple in the portfolio that have gone through the process at the moment that I know are finalising their due diligence and negotiating terms. Some of those syndicates have actually already approached and sort of given a flagging that it's coming through and actually starting to engage with the investment committee. So it won't surprise me if the first investment probably happens within a couple of weeks of that first close. The second one, there's a couple that are sort of at early stages of DD, and then a couple of follow-on ones that are coming through. So I think we'll see the first one relatively quickly, and then a couple, relatively shortly thereafter.
Awesome. I think this is a great question. What level of reporting will be provided each quarter, i.e. fund valuation, new investments, update on existing investments, etc.?
Yeah, so what normally happens is there's normally a quarterly investment report, and that quarterly investment report will update on the status of the fund at that particular point in time. The usual things like the amount of capital that's been called, the current value of those investments, and it will normally have a full list of all of the portfolios companies in that list. It will also provide the general updates on that. So as new things are actually happening, you'll get the regular ones. I think what we'll also see, and the great thing about the VentureCrowd platform is actually set up to do reporting. So when you invest via VentureCrowd, you get your portal, you've got reporting details on that. So we'll actually go out and you'll get pushed that information around it. So you'll be able to follow on the information on those companies that gets reported out. I think in the early days, it would be my intention that we try to have probably as we're doing things more updates especially as we're making a new investment, because I think people like to know what's actually happening, especially in those earlier stages. It's going to be boring if the first one's like, oh, we've made one investment and that's it, and then you have to wait for the next quarter to work out we've actually made a couple more investments. So and then over time, then you sort of keep getting regular updates. But as new rounds are being done and companies are being revalued, you'll get that information as well. So investors will get the full list of information around it.
Terrific. So how do you see the broader market for startups and startup investing, noting the likely headwinds as a result of the Trump administration, tariffs, geopolitical tensions, as well as the rise in private credit?
Oh, there's a lot in that question. I think the startup market's in a really interesting position. If I compare it to when Sidecar Fund 1 and even sort of to a certain extent 2 was started up, is like Sidecar Fund 1, I think from memory, was the third registered ESVCLP in the country. So it was really, really early on. And the ecosystem was really, really young and undeveloped. So the ecosystem today for startups is far, far better than it has ever been and continues to get better. The benefits of things like AI that are coming through, I think, are actually making it easier for startups to sort of grow and do more with less dollars. So I think there's a really good opportunity in that. And even if they're not sort of AI pure startups, but they're using AI as part of their platform, I think things like Trump administration or tariffs or geopolitical tensions, I think in some respects there's a degree of almost like a degree of noise in some respects. Yes, it has broader impacts, but you've got to remember we're investing in things that are the earliest stages. And when you're a really, really small company, like it doesn't matter how fast or slow the economy is growing, you can grow far, far faster than it because you're trying to create and do something different. In some respects, in tougher economic times, companies and individuals are actually looking for more cost savings. They're actually looking for better returns out of things. So that innovative startup can quite often have a better value proposition to someone in a tougher economic time. The rise in private credit, it doesn't really have a significant impact in startups. Like startups are generally not borrowing money until they're a little bit more advanced. There is a growing venture debt sector in Australia. I actually see that as a really strong positive because what it really means is less equity dilution and therefore more value to equity holders for those startups that use that private credit feature and functionality appropriately.
Great. So if an investor seeks assistance from VentureCrowd to aid in an off-market transfer, would it generally be expected that a current or approximate net asset value could be rationalized, noting that it would be this amount which the 2% is levied on?
There's a lot in that question too. It's probably the easiest way to describe it is that you probably shouldn't think about there being any significant liquidity. Yes, there is the ability to do off-market transfers of the fund interest. Obviously, there would be guidance for net asset value is what people would actually use, but in a lot of cases, secondary transactions of funds do actually trade at discounts to those values, and really it's a function of how desperate is it the seller to want to get out of that, and how desperate is the potential buyer to want to come into that. So it's really difficult to understand what that difference might possibly be, but we would be saying to people, you should be thinking about this as potentially a small, well, depending on your risk tolerance, a small allocation of your overall portfolio, which you should consider as being illiquid. Like we wouldn't expect there to be distributions coming out for sort of 4 or 5 years. At the earliest, in sort of 4 to 7 will be sort of that kind of general time frame around it. So yeah.
Awesome. So there's been some questions around the fees. Could you clarify whether the full fee is billed at the first call and whether there are scenarios where the fund might not proceed with all future calls? And if so, what happens to the upfront fee?
So there's a couple of fees that happen. So there's an upfront contribution fee, which is 1% plus GST. That is paid based on the full committed amount upfront as part of the first call. So irrespective of the later calls, that's all paid upfront. Part of it's just due to it's much easier from an administration purpose. But at that particular point in time, all the core work for sort of making that initial commitment has been done, which is why that fee is payable. Up front. It would be pretty unusual for the full call not to be made on it. You'll generally find it would be. You do get some scenarios. And this happened with Sidecar Fund 2, where you might get some exits that happen prior to the final calls being made. So what normally happens is that exit amount is then allocated to the call. So your call effectively gets paid, the final capital calls effectively get paid automatically out of the exit proceeds that are coming in. So they still are called, they still are paid, but you don't have to dip in your own pocket for it because it's the proceeds that come out. The fund can't reinvest proceeds, so it can't sell an asset and then take that money and then sort of reinvest it into more companies at all. Once it sells that asset, it has to distribute it back out. And then the other fees that are paid, there's a 2% management fee that gets paid per annum. For the first 5 years, it's effectively on the committed capital amount. And then after 5 years, it can decline smaller to lower those numbers. So if things are being written off or have been exited, as the committed capital comes down, that management fee comes down as well. And then the final fee is a performance fee, which is a 20% carry. So once all of the original investment has been returned to investors, which includes sort of the recuperation of the management fee. At that particular point in time, gains above that have a 20% carry on it, which is, say, 20% of the profits after the return of capital is sort of paid out as a performance fee.
Makes sense. So obviously, since the raise opened, it's exceeded the targets quite significantly. And with 3.2 million raised in under 24 hours. What does that early momentum mean for the pace of future investments or potential deal access? And will fund deployment happen faster as a result?
Look, in some respects, I don't think fund deployment is going to happen specifically faster as a result of it. I think the mistake that some people make is that they've got money and they sort of loosen up their discipline and their process as a result of it. I mean, the whole point of this fund is to sort of make sure you follow the process and have that discipline around it. You're not going to necessarily speed any of those things up because there's this cycle process that actually happens. It could be that maybe some of the follow-ons on previous portfolio companies, we might do more of those like a little bit faster because the fund's been raised a little bit faster. But I don't think overall it's going to make a significant change to the discipline of the fund and what it's trying to achieve.
Absolutely fair enough. I know we've gotten through quite a few questions, but does anybody else have any further questions for Adrian while we have him? Obviously, if you do have any that you want to ask him, you're absolutely welcome to get in touch after we finish the webinar. But it looks like we've gone through all of them today, Adrian, in a very quick 40 minutes. That's absolutely flown.
Yeah. Look, I think obviously, yeah, Emily, and I appreciate the questions that have come through. That's been really good. If this is being recorded, so if people do want to reach out with other questions, they're more than happy to do that. Yeah, I know the team at VentureCrowd are great at answering a lot of the questions that come through. We've got a lot of common questions that come, and if anything that can't be answered, we're sort of more than happy to help people through that process. And one of the questions that we get asked around it, and I think I touched on this before, but it's like people who are already in the sector, like should they actually also be looking at the sidecar fund as well? And look, my response is like I'm not going to give them personal financial advice around that, but I tell them the way that I think about it, right? So I do the direct investment, but I'm also investing in the sidecar fund. And the reason I'm doing that is that I get that diversified access to every single company that comes through and filters it. And the one thing I've learned over sort of doing angel investing over the last 15 years is that there are some companies that I think are brilliant and don't go that well, and I've invested in them. There are other companies I've thought, oh, I'm not so sure about that one, and I haven't done it, and those things have done spectacularly well. So it's very, very difficult to pick who the winners are going to be in that, which is why having that diversification is quite good. What the Sidecar Fund lets me do is it lets me have access to everything that goes through and gets done. But the things that I do have particularly strong conviction on that I believe are going to matter, I can put more direct dollars into those ones. That sort of leads into then another question is people who generally invest not at those super early stages because it is a lot of work to do it, like are they thinking about how do some of those investors think about sidecar fund? And some of those investors, and I know there are a couple in the earlier funds that ordinarily wouldn't invest at those very super early stages, but what they did is as a result of doing that, they got access to performance information on those early startups. And they would generally want to invest at slightly later stages. So they had the benefit of following a company for sort of 12, 18, 24 months to see how they were tracking. We would then let them know when companies are sort of looking to raise capital if there's an opportunity around that. And some of those investors then went directly into those companies and put much, much larger amounts of money directly into those companies and made far more money as a result of that than they made out of the fund. And if they hadn't have had access to the fund, they would never have seen those companies. They would never have got access to those deals. The fund gets to build a relationship with those startups, and we get to help those startups raise capital because it's also, it's always one of the hardest jobs for those startups. So there are a couple of benefits for those people who are looking to invest larger amounts later stages as well.
Great. And I've got one more question. Who do I speak to if I want to invest?
Well, you're probably best to answer this, but it's speak to the VentureCrowd team. There's on the VentureCrowd website. You can do Q&A. You can reach out to the team there. They sort of filtering things through, and then stuff that they can't answer, they sort of filter through to Sydney Angels. And just probably the other thing, it's in the fund, but again, people talk about like how does the investment committee work in this? There's effectively four members on the investment committee. There's two members from Sydney Angels. It's myself and Philip Argy. And then there's two members from VentureCrowd, which is Steve and Stephen around it. And it's a sort of a joint decision around that. And again, it's more around the process around it. And I think people people ask us like, well, how often do you sort of say no to those investments? And I think it's very rare. I think it's only been once on one of the other funds that it was said well, it wasn't even said no. It was like it wasn't quite ready. It wasn't quite right. You need to fix up a couple of things. Go fix up those things. It'll be okay. And I think the reason for that is because people investing in the sidecar fund so they can come invest alongside the Sydney Angels. And unless there's something drastically wrong with the due diligence, I think the fund would hate to be going, oh, we decided not to invest in that one, and that was the one that happened to be the best one that actually came out of it. That would be disastrous.
Absolutely. I've popped the link to the raise page in the chat. So if anybody wants to have a look at it, please do so. And you can reach out to our team from there if you've got any extra questions. But thank you so much for your time today, Adrian. And thank you, everybody, for your unbelievable questions. They were really great. And it's good to see there's such a huge amount of interest in the fund. So thanks so much.
Great. Thanks, Emily.
Take
Thanks,
care.
everybody. See you.
Bye-bye.
Bye.